Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden truths within corporate filings. Today we're diving into a document from Nuburu Incorporated that seems to be setting up a busy year ahead for their stockholders. This report is essentially a heads up for an upcoming special meeting where shareholders will be voting on some pretty significant proposals. Think of it as a pre-game show before a major event, and we're here to break down what is really going on. We'll be looking at new share issuances, potential stock splits, and even some approved financing deals. Before we jump in, if you're new here and love getting straightforward, nonsense analysis of corporate documents, make sure to hit that subscribe button, and don't forget to join our community Discord, linked in the description below, where we keep the conversation going 24/7. Alright, let's get straight to it. Nuburu Incorporated is holding a special meeting of stockholders on the 12th of March 2026. And it's not just for a casual chat, they've got a packed agenda, basically asking for the green light on several key financial and corporate structure decisions. First up, proposal number 1. This is about approving the issuance of shares of common stock that go beyond certain limits set by the nice American Stock Exchange. This is tied to warrants issued in a private placement that closed back in December of 2025. Essentially, the company made a deal to raise capital, but the deal involves issuing more stock than usually allowed without shareholder approval. They need your say. So to make this happen, because the deal involving warrants that could lead to issuing many more shares, potentially over 19.9% of their current stock, needs this extra green light to comply with stock exchange rules. These warrants are quite complex. They can be exercised to buy shares, but to raise a limit on how many shares one investor can own at any time, keeping it below 4.99% of the company's outstanding stock. This is a common way to structure these deals to avoid triggering certain regulatory requirements or to allow for more flexibility in ownership over time. The company is saying they need this financing to move forward with their transformation plan, which sounds like a major business overhaul. Now, here is the kicker. If stockholders do not approve this, it could severely impact the company's ability to raise capital. They might only be able to issue a fraction of the shares originally planned, leading to much less funding. This could mean cutting back on their business plans, reducing expenses, or even selling off assets. It sounds like this financing is pretty critical for their survival and growth strategy. Next, proposal number 2. This one is straightforward but has big implications. They want to increase the total number of authorized shares of common stock. Right now they can issue up to 900 million shares, but they want to bump that up to a massive 2 billion shares. This is often done to give a company more flexibility for future financings, acquisitions, or stock-based compensation. The company states they need this because of their transformation plan, which involves raising significant capital and potentially acquiring strategic companies. They also need shares for employee compensation, paying off debt, and for other business deals. As of the record date, they were already running quite low on available shares to issue. Increasing the authorized amount to 2 billion would give them a lot more room to maneuver. It's important to understand that while this gives the company more flexibility, it also means that if they issue a lot of new shares, your ownership percentage in the company will likely go down. This is called dilution. It's a key trade-off for stockholders, more flexibility for management versus potentially less ownership for existing investors. Then we have proposal number 3, which is about approving a reverse stock split. A reverse stock split is where a company reduces the number of its outstanding shares, which usually increases the price. Per S-Hair, the company is asking for authorization for the board of directors to execute one or more reverse stock splits within the next 12 months. At ratios they can decide on up to what the nice American allows. The main reason here is to maintain compliance with the stock exchange's listing rules. Often, companies do this to get their stock price above a certain minimum threshold, like $1 per S-Hair, to avoid being delisted. It's a way to make the stock look more attractive, and potentially to institutional investors who might shy away from very low priced stocks. However, there are risks. The company admits they can't guarantee that the stock price will stay up after a reverse split. Sometimes investors see it negatively and it doesn't solve the underlying business problems. Also, if you own a small number of shares, a reverse split could lead to you owning less than a full share. And you might have to deal with cash payouts or higher trading costs for those fractional shares. Interestingly, they've included a section on the tax consequences, which is quite detailed. For most US holders, they expect it to be a tax-free event at the time of the split. However, they specifically warn about the tax treatment of receiving a fractional share or a rounded up full share in lieu of a fractional share. and advise consulting with a tax advisor. This shows they want to be transparent about potential tax implications for shareholders. Proposal number 4 is asking for approval to issue up to $100 million worth of securities in private offerings. The key here is that these securities can be offered at a discount of up to 30% to the market price. This is another mechanism for raising capital, but again at a discount, which leads to dilution. This authorization is valid for only 90 days after stockholder approval. This suggests they want the flexibility to move quickly if a good financing opportunity arises. The company explains they need this to implement their business strategy, pay vendors, and manage liabilities. Once again, dilution is a major theme. Issuing shares at a discount means they will get less cash per share than the current market value, and existing shareholders will see their ownership percentage decrease. Proposal number 5 is about approving the issuance of a specific number of shares, about 6 million, to SE Equity Investments SARL. This is related to financial assurances provided for a transaction involving a company called Techni. It seems SE Equity Investments provided crucial financial backing, likely in the form of an escrow deposit or guarantee, and these shares are to compensate them for that support. The company is seeking approval out of an abundance of caution, especially since one of their directors, Matteo Ricciabruno, was previously associated with SFE Equity Investments. While they believe Therese no conflict of interest, they are being transparent and ensuring all bases are covered regarding stock exchange rules. If this is not approved, it could jeopardize their plans to acquire a controlling interest in Techni, which they consider critical for their transformation plan. This highlights how interconnected these various proposals are. Proposal number 6 deals with a related party transaction. Nuburu Incorporated plans to acquire the remaining equity interests in a company called Orbit SRL. The catch is that Orbit is wholly owned by Alessandro Zamboni, the company's executive chairman and co-chief executive officer, through another entity. This is a significant 50 million share issuance because it involves a related party, New York. SE rules require stockholder approval. The company says the acquisition of Orbit is a fundamental step in their strategy to become an integrated defense and security platform company. Orbit provides a software backbone for operational resilience and business continuity, which they believe is crucial for both civilian and defense applications. They see Orbit as a key piece for their dual-use strategy, leveraging a single software platform across defense, security, and regulated civilian markets. This acquisition, they believe, reduces execution risk because Orbit's platform is already proven with civilian clients. They are essentially merging a software solution with their hardware technologies. Orbit's recent financial performance, as of the 31st of December 2025, shows a company in a turnaround phase. Revenue was around 336,000 euros, but they had an operating loss of about 1.37 million euros. This reflects intentional investment in product development and restructuring, not steady state operations. The board believes these actions have reduced risk and set the business up for future growth. This issuance of 50 million shares will obviously dilute existing stockholders. It also could have an anti-takeover effect, making it harder for another company to acquire Nuburu. Finally, proposal number 7 is the adjournment proposal. This is essentially a safety net. It allows the company to postpone the meeting if they do not get enough votes to approve the other proposals or to establish a quorum. This gives them more time to convince shareholders or gather more votes. This is pretty standard practice for special meetings where there are a lot of important and potentially controversial proposals. It is a way to ensure they don't get stuck without making decisions just because they didn't get enough immediate support. Now, let's look at who owns what. As of the 11th of February 2026, we see a few key players. This table shows beneficial ownership, meaning who actually controls the shares, not just who legally owns them. There are some sizable holders like the Vanguard Group and, of course, the company's own management and directors. The Vanguard Group is noted as a major stockholder. Ownership figures are not fully disclosed in this excerpt, but their presence indicates significant institutional interest or investment. The executive chairman and co-CEO Alessandro Zamboni holds a notable number of shares, some of which come from convertible notes held by entities he controls. This reinforces his deep involvement and stake in the company's success. When you look at all directors and executive officers combined, they hold a certain percentage of the company's stock. It's important to see that management has a vested interest in the company's performance, which can be a good sign for aligning their interests with other shareholders. Now, looking at these proposals and the ownership structure, Nuburu Incorporated is clearly at a critical juncture. They are aggressively pursuing a transformation plan that requires significant capital infusion and structural changes. The proposed increase in authorized shares and the potential for multiple reverse stock splits signal a strong need for future financial flexibility, possibly to fund ambitious acquisitions or overcome existing financial hurdles. The company is relying heavily on external financing, as seen in Proposal 1 and 4, and is willing to offer discounts on new stock to secure that capital. This, along with the related party acquisition of Orbit and compensation to FAE equity investments, means existing shareholders will likely face further dilution. The reverse stock split, while intended to lift the share price and meet listing requirements, carries its own set of risks, including potential negative market perception and increased trading costs for small shareholders. The overall direction seems to be one of growth and restructuring, but it's coming at the cost of significant dilution for current investors. The strategy to integrate software with hardware in the defense and security sector is ambitious, and the success of Orbit's acquisition will be a key indicator of this plan's viability. However, the reliance on discounted equity offerings and the complex web of transactions suggest a company under pressure to secure funding for its strategic vision, with a real possibility that current ownership stakes will be significantly diminished. The company's ability to execute this transformation without further financial distress and to truly leverage its new strategic direction will be the ultimate test. Alright, that is our breakdown of Nuburu Incorporated's latest filing. What is your take on these proposals and what they signal for the company's future? Do you think these moves are necessary for growth, or are they a sign of deeper financial issues? Drop your thoughts in the comments below. If this analysis was valuable to you, hitting that like button really helps us out, and make sure you subscribe for more deep dives into the world of corporate finance. And don't forget to check out our Discord community, linked in the description. Thanks for watching, and we'll see you next time on Corporate Decoder.